recording. Okay, now let's get the PowerPoint pulled up. Alright, there we go. Alright, so welcome back everyone. We left off on Wednesday, with other assets, the section right here, the other asset section of the balance sheet. So we'll go ahead and move on today with the next topic here. We'll start with current liabilities. So we know current liabilities are going to be just liabilities that we have to satisfy within a year of the operating cycle, right? So no need to really harp on that. They say here these are the most common types of current liabilities that you'll see from companies. Payables, accrued expenses, deferred revenues, which obviously unearned revenues, we've established that, short-term debt, and current maturities of long-term debt. So payables, we know that's like account payables coming from trade, right, from our suppliers and stuff like that who lend credit to us. Accrued expenses, stuff like electric bills, water bills, wages payable, stuff like that, interest payable, stuff like that. Deferred revenues, we know that's where people pay us up front, right? But we haven't earned the money because we haven't performed the service or provided our good yet. Short-term debt, we know what that is. And then the current maturities of long-term debt, that's that portion of long-term debt that's due within a year, right? So we have to reclassify that as short-term at the balance sheet date. So the liability section of the balance sheet, we know we have current liabilities, which we just had. We listed there the accounts payable, salaries payable, income taxes payable, advances, so on and so forth. So they're listed, and then we sum them up for total current liabilities here. And then by default, we have the long-term liabilities, right? Because anything that's not considered current current liabilities is by default going to be long-term. And then here we can see the bonds payable, and less than amortized bond discount. Mortgage payable, accrued pension cost, and deferred income taxes. And then same thing that we did with the total current. We just sum them up here on this line right here. So then obviously we add the two together to get the total liabilities right here. So that's just how they're presented on the balance sheet here. Okay, now what types of current liabilities are there? Once again, we went through these. We've already went through them. So really, I don't see any need to really reharp on them. Once again, accrued expenses, that's obligations for goods or services, like we said, that we've been received but not paid. Deferred revenues, obviously, that's where we're getting the money up front, like I just said, and we haven't done anything to actually earn it. We haven't provided the good or service. Short-term debt and current maturities of long-term debt, once again, like we just established earlier. This is going to be the part of the debt that's currently due within the year of the operating cycle, so we have to reclassify it. Okay, long-term liabilities, obligations that are not expected to settle within a year, right, or the operating cycle. Most are going to be reported at their present value unless the company elects the fair value option, okay? Interest rates, maturity values, and other provisions are going to be disclosed parenthetically. That's going to be on the balance sheet or in the notes, right? So that's your two options we have under GAAP. You can either put them in parentheses to the side or in the notes to the statements. Okay, the types of long-term liabilities, long-term accruals. These include obligations that may be outstanding for many years, including obligations for pension and other post-employment benefits, estimated liabilities from long-term warranties, and deferred tax liabilities. Okay. Long-term financing instruments, formal borrowings to finance the assets and operations of the company, including long-term notes payable, capital lease obligations, mortgages payable, and bonds payable. Other liabilities are miscellaneous liabilities that do not fit into one of the previous categories. Okay, so I think everyone from principal should be pretty familiar with the difference between the current and long-term or non-current liabilities. Okay, here's a real report, long-term debt. So we can just see here how it would actually look on the excerpt of a company's statements here. So this is Kimberly-Clark Corporation liabilities in part. We can see here the two different year ending, the first one 2016, the second one 2017 here. It shows the current portion of long-term debt, so we can see that. Then we have the long-term debt. Then notes to the financial statements right here. So this is note 7 for debt. So this is just pretty much showing what we were talking about as far as either in parentheses or in the notes. So that's just showing how they have them, the breakdown of it, pretty much the interest rates here, the weighted average interest rates, the maturities, and so on and so forth. So does that make sense to everybody? Okay, let's move on to shareholders' equity. So this is going to obviously be the residual interest. So the owner's claims to the assets after all satisfied, after all liabilities have been satisfied. Sorry, bear with me. I'm obviously having a hard time talking today. Shareholders' rights are defined by laws of the state granting the corporate charter. So what that means is every state, their corporate charter, it's different. So sometimes certain states might have like no par for stock that's issued. Some states have a par value for common stock, stuff of that sort. So depending on which state you incorporate in, is going to determine what type of laws you have to abide by. That's why a lot of companies will operate, and there's like 2 or 3 states that are really friendly as far as their corporate laws go. And that's why you'll see a lot of corporations based out of those particular states. Can't think off the top of my head what they are, but I know there's a few states that are really friendly with their rules. Consists of 2 components: contributed capital and earned capital. What's the difference between contributed capital and earned capital? Right, like owners, like from issuance of stock, right? That's going to be contributed capital. So when owners actually buy into it, or like we would buy into it. So that's when we contribute capital, when we purchase equity instruments. And so if that's contributed capital, what's the earned capital?
Residual earnings.
Right, that's pretty much just our net income or net loss, right? So when remember, net income close to retained earnings, right? And the same as the accumulated other comprehensive income, where that's from the items of other comprehensive income. Remember, we spoke on that a little bit earlier in this chapter on Wednesday. So those are going to be your 2 earned capital, and then obviously the contributed capital is from the issuance of stocks. The third component can arise when equity capital is invested by non-controlling interests. So once again, that's the non-controlling interest portion of it, and that's only if a company has acquired another company, and they have an ownership percentage, but less than 100% of the stock out there. That's when you'll see that non-controlling interest in the equity component. Contributed capital is recognized when a shareholder acquires shares directly from the corporation. So once again, we established that. That's when they're just buying into their stock, and we have the par value or stated value. All that is the minimum dollar amount per share that investors are required to invest. So it can't drop below that right there, right? That's pretty much the floor on an offering of an equity instrument. Contributed capital can involve as many as 4 or more components. So first, common stock. So obviously this is the most prevalent type because it gives you ownership rights and it gives you voting rights. So that's the most prevalent type is common stock. Treasury stock is obviously when a company buys back its outstanding shares that are in the marketplace. So treasury stock, I want to note that that is a contra equity account, okay? Treasury stock is. So what do I mean by that if treasury stock is a contra equity account? Think about in terms of depreciation. What is accumulated depreciation? That's a contra account, right? So if accumulated depreciation is a contra account, we know that's carried right next to the fixed assets, right? So if we have like equipment, then we'll have accumulated depreciation equipment right below that on the balance sheet, right? And where it reduces the value, right? Because it's a contra account to that. So if treasury stock is a contra account, then what does that do to overall equity? Decreases it, right? It makes sense because they're buying back some of the stock that was out there in the public, so less equity is going to be out there, right, in the owner's hands. It's going to be in the company's hands again, right? So that's a debit balance. Treasury stock's a debit balance, whereas all your other equity or credit balances. Okay, so it's a contra equity account. Now, preferred stock, which has different types of ownership rights from common stock. Pretty much with dividends, if they're preferred, you can have participating, non-participating, cumulative preferred stock, different types. We'll get into that at later points in time. But for now, just know preferred stock, you don't have any ownership rights. You don't get any voting rights of anything on preferred stock. So that's the difference between common stock, preferred stock, and treasury stock. So example, Crossley Corporation sold 100 shares of its $5 par common stock for $30 per share. So the journal entry to record this, we can see here we have cash, $3,000, right? Because that's going to be the 100 shares at $30. So 100 times 30 is 3,000. We're receiving that cash, right? Cash is an asset, so we debit it. With it coming in, cash is increasing. Then what we want to do on the credit side of it, we want to credit common stock for the par amount, right? So 100 shares times $5 is 500, and then everything over it is additional paid-in capital, right? And did everyone learn that in principles? Is that a principles concept? I thought it was. I'm new teaching principles, so I'm not really. It's been so long since I actually took principles, I don't really remember what was covered in it, but I figured that it would be. So receive the cash, debit it, credit common stock for par, credit additional paid-in capital for anything in excess of par. Pretty simple. Next, the earned capital consists of retained earnings and AOCI. Remember, AOCI is accumulated other comprehensive income. Retained earnings is just the total amount of corporate net income that's been earned but has not been distributed to shareholders as dividends, right? So we know that the only thing that's going to affect the retained earnings, right, is going to be net income and dividends, right? Either net income is going to increase it, or net operating loss is going to decrease it, or if we declare dividends, then that's going to obviously decrease it because dividends are charged to retained earnings, right? A deficit arises when cumulative net losses or dividends exceed cumulative net income. Makes sense. So if they're obviously bringing in less money than what they're earning, or if they're bringing in not enough money to cover their expenses, then that's going to be in a deficit in the red. And if we're paying out more money to owners than what we're bringing in, then obviously we're going to be in deficit, which makes sense. I mean, you can break that down on a personal level. If you're spending more than you're bringing in, you're going to be in a deficit, right? Accumulated other comprehensive income loss is the cumulative amount of other comprehensive income or loss. And once again, that's just going to be at either the bottom section of your income statement or on a separate section or on a separate statement for the OCI. And we'll get into that in more detail later in the semester as well. Once again, the non-controlling interest, this is going to arise when the parent company purchases a controlling interest in a subsidiary in another entity. And they have over 50%, so they have at least 51% of their common stock outstanding, but less than 100%. So that non-controlling interest just shows the equity of whoever makes up the non-controlling interest. It could be one party, be 1,000 parties, whatever it is. So if you see a non-controlling interest component of equity, we know that a company has a controlling interest in another entity, okay? So what exactly is the statement of shareholders' equity? So obviously financial statements must include a disclosure of the ending balances and the changes in its shareholders' equity accounts. It says here the SEC requires a separate financial statement for publicly traded companies, but smaller companies and private companies may report in a supporting schedule or in the notes to the financial statements, okay? So if you're public, then you have to have a separate statement for this. If you're not public, then you have a little bit of leeway and you can either have your statement or just throw in the notes like it says, or in a schedule attached to it. So not bad there. FASB Statement of Financial Accounting Concepts number 6 is defined. Investments by owners are obviously going to be increases in the equity of a company resulting from transfers of something valuable to the company from other entities to obtain or increase ownership interests. So obviously that's investments to owners, money's coming in, right? Distributions to owners obviously are going to be decreases in the equity of a company caused by transfers of assets, rendering services, or incurring liabilities to owners. So obviously, investments to owners, money or assets coming in, distributions to owners. It's money or assets going out, services going out, right? Pretty simple. Okay, to report investments, buying distributions to owners, companies prepare a statement of shareholders' equity or the statement of changes in shareholders' equity. All it does is just reports the changes in contributed capital, treasury stock, retained earnings, and AOCI, non-controlling interest, if any, as well as ending balances. So pretty much it it's just summarizing your equity section, right? Which makes sense because obviously the statement of shareholders' equity. So at the end of the period, whatever all the changes are, then we just have to show that net effect in these components of equity right here. So here's an example of a statement of shareholders' equity right here. We can see here that on the left-hand side, we have the balance as of January 1 of 19. On the bottom, we have the balance as of December 31st, 2019. And then right through here, we can just see the different components of shareholders' equity here with the common stock, additional paid-in capital, retained earnings, and accumulated other comprehensive income. And then we have the total line, right? So we can see here, as of the beginning of the year, this is what our beginning balance was right here, right? So it's for a total of $285,300. This is what makes up that amount, right? So we're moving from left to right here. And then from down here, we just record the activity that occurred throughout the year, right? So first net income, then obviously we had $62,500 in net income, so we were profitable that year, right? Remember, net income is close to retained earnings. That's why it's increasing, right? Looks here like the company paid cash dividends, declared and paid cash dividends of $11,200. So obviously that's going to affect retained earnings. It's going to decrease it. That's why we see it going down here. Common stock issued. We issued $6,500 of common stock right here. In additional paid in capital, we brought in $30,500 over par, right? From there, we can see we just sum them up going down to get the ending balances for each individual component right here, and then sum them across for the total for the difference between the end of the year balance and the beginning of the year balance. Does that make sense to everybody? Not bad, right? Just have each component, show the beginning balance, show the changes throughout the period, add them across, add them down, there you are. That not make sense to anybody? Everyone good? Okay, additional balance sheet disclosures. So obviously, not all relevant information can be included within the line items of a financial statement, right? Because quantitative information is good, but it can't tell everything, right? So we have to have some qualitative information to go with it. So once again, it says here, not all the relevant financial information about a company's financial position and activities are in the body of the financial statements, okay? So many issues may instead be disclosed in the accompanying notes to the statements, summary of accounting policies, fair value and risk of financial instruments, and loss and gain contingencies. What do you think a summary of accounting policies? What would be one of the summaries of an accounting policy? Maybe an inventory method, LIFO or FIFO, how they carry their inventory, because if we just look at the line item on inventory, all that tells us is the dollar value of the overall inventory, right? But we don't know how they're valuing it. Is it weighted average, LIFO, FIFO? Because that has an effect on how it hits your income statement. It has an effect on your earnings, and it has an effect on really the value of your inventory, right? So that's just a summary of accounting policy. So we can see why it would be important that they would have to disclose that, right? Because we need to know how did you get that amount right there, right? Loss and gain contingencies. What would be an example of something like that we should disclose in the notes for, let's say, like a loss contingency? Maybe a lawsuit if we're in litigation. Maybe the company's being sued. We should probably let our readers be aware of that, right? Some other accounting policies. Usually, the first financial statement note informs external users about the company's accounting policies, practices, and methods. So that's usually going to be the very first one, so they can get to it really quick to know how they had the measurement attribute on the balance sheet, right? It includes principles relating to the revenue recognition and asset allocation, particularly when these principles and methods are going to be choices from existing acceptable alternatives, peculiar to the industry in which the company operates, unusual or innovative applications of GAAP. So what could be an example of choices from existing acceptable alternatives?
Like the inventory
for. Same thing we just talked about, inventory, whether we are elected the fair value option or we forego it, stuff of that sort. Okay. Information about leases, whether it's operating or capital, stuff of that sort. Okay, fair value and risk of financial instruments. So obviously financial instruments includes stuff such as stocks, bonds, notes payable, receivables, and as well as more exotic instruments. Okay. U.S. GAAP requires disclosure in the notes to the fair values of all financial instruments, whether or not they are measured at fair value on its balance sheet. Okay. A company is also required to disclose all significant concentrations of credit risk due to its financial instruments. What's an example of a concentration of credit risk? Pretty much you got all your eggs in one basket for the most part, right? So you can even look at it in terms of trade. Like if you get a lot of your money from one trade partner, right? You have one really big customer, and say you have a lot of money out there on your AR from that customer. That's a concentration of risk, right? Of credit risk. Because what if that customer defaults and they make up 60% of your accounts receivable base? Wouldn't we consider that a concentration of credit risk? So that's what we mean by that. GAAP requires disclosures of the fair value of all derivative financial instruments on its balance sheet. A derivative financial instrument derives its value from changes in the price of the underlying resource to which it's linked. So what are we talking about there for like a derivative instrument? So it's pretty much like, say we have a stock, okay? I mean, and instead of actually like buying into that share of stock, maybe we get a derivative, and then it's just based on the underlying on how it moves, right? So it's settled based on the underlying. So there's no net settlement of the asset. Or if you're buying like if you have a derivative of like oil or something, you're not actually buying the oil, you're betting on the underlying, the way it moves. Okay, so that's all it's saying, and we'll get into that later. That's more of a complex topic, but right here it just says obviously it derives its value from changes in the price of the underlying resource to which it was linked. So that's the derivative. It derives its value from the underlying. Okay, loss and gain contingencies. Certain situations that exist on the balance sheet date as a contingent losses or gains are known as loss contingencies or gain contingencies. Okay, so pretty much the long and short of this rule is if it's probable and estimable, okay, for a loss contingency, probable and estimable, we have to present it within the statements, okay? So if it's probable, meaning there's a pretty high likely chance that it's going to occur, right? I want to say I think it's like 70% chance is what the actual threshold is. 70, 75, maybe somewhere around there. I'm not totally sure right off gate. So that's probable. So if it's probable and estimable meaning if we can estimate what the loss is going to be, right? Then we have to accrue it as an expense and set up a liability within the financial statements and then disclose it in the notes, okay? Okay, so if it's probable and not estimable, then we just to close it in the notes, right? Gain contingencies, no matter what, even if it's probable and estimable, you never accrue it in the statements, because why do you think we would never accrue a gain contingency in the notes? It links back to one of the things we talked about, I believe, in chapter 2. Conservatism. Because what if we don't get that gain? Then that's going to be misleading the readers, right? So see how these things tie in to why we were talking about all those matching concepts and conservatism and all that. Because if you know the framework, then it can help guide you onto these rules like this. So we know we're not going to include a gain contingency, because that could be misleading. It could overvalue the company. But we do want to, however, include a loss contingency, because we want to be conservative. Because if there's a chance we could incur a loss, then we want to make sure that that's known, right? If it is probable and estimable, then within a range, if there's a range, like I say, we could lose either 100,000 or 200,000. You take the most conservative one, 100,000. If there is a range, but then a best best bet or best estimate. So it ranges 100 to 200,000, and 150 is your best bet. You accrue for 150. Okay. Do we ever accrue a gain contingency in the statements? No, right? Because it goes against conservatism. When do we actually accrue something? When do we accrue an expense and set up a liability as far as a loss contingency? What two things makes it to where we have to realize it, recognize it?
Probable.
Yep. Estimable. Yep. Probable, estimable. Probable, estimable. Okay. And that's something that you won't get away from. That's heavily tested on the CPA right there. So that's long and short what it is right here. Subsequent events is one that occurs between a company's balance sheet date and the date when it issues its annual report. So we know that usually the end of the period is December 31st, right? Well, the statements usually don't come out till like March, into March, something like that, March 15th, somewhere, March 1st, or whenever a company produces its financial statement. So what they're saying here is that that's the period of time. If something happens, that's a subsequent event within that period, right? So if it happens from the time the balance sheet date and the date that the financial statements are issued. An adjustment to the financial statements is required if a subsequent event provides additional evidence about conditions that existed on the balance sheet date. So what's that mean there? So pretty much what it's saying is if we get new information within that subsequent period, that subsequent event period, from the date of the balance sheet date to the date the statements are coming out, if it relates to something that happened within the reporting period from January 1 to December 31st, we need to adjust our statements for that before we issue the statements. Makes sense too, because the statements that are going to be issued reflects what happens during the reporting period, right? So even though the information was available after it was still within the period before it was issued, so we need to make sure we adjust it, okay? It says here, a material subsequent event that does not affect the company's closed financial statements is instead disclosed in a note, in a pro forma as-if statement, or in an explanatory paragraph in the audit report, okay? So if it affects it within the period, if it's information coming from stuff that's happened, we have to adjust the statements. If it doesn't, we just report it in the notes, right? Next, related party transactions. They may not be conducted at arm's length and could be viewed as self-dealing. So what do we mean by arm's length here?
Kind of like inside your own company.
Yeah, well, related party transactions, it could be within our own company or with, a company that we control or something of that sort. But when we mean by like arm's length, that's just a business saying by like just an outsider, like two independent people coming together and making a deal. That's an arm's length transaction. So meaning it's going to be more fairly stated, a fairly more stated price of whatever we're doing, right? Because you're gaining something of value if I'm selling you something, and I'm gaining something of value because I want to sell it, right? So that's an arm's length. So what they're saying here, related party transactions, we need to be careful about those on the reporting of them, because a lot of times they could lack substance, meaning they could be like not really fair value terms. So like I could give you all a really good deal on a building because we're a related party, so I might give it to you for less than fair value. So that's all that's saying right there. So obviously, GAAP's going to require certain disclosures about a company included, and that a company that has dealings with related party transactions. They want to know the nature of the relationship involved in the transaction, a description of the transactions, dollar amounts of the transactions, and any amounts due to or from the related parties on the balance sheet. Okay, so it makes sense, right? That pretty much breaks down just the whole entire outline or the framework of that transaction, right? Comparative financial statements. So for the current and preceding accounting periods, these are going to enable external users to identify trends in the company's financial position and performance. So what we mean by comparative financial statements, we'll have a couple years of the income statement, balance sheet, and then statement of owner's equity. And from there, we can see the changes from each reporting period, from how the performance was on the income statement to how your position is on the balance sheet and the changes in the statement of owner's equity, and the same thing for each year, so you can analyze that and see the trends and what's happening in the company. So that's what comparative financial statements are for. It says here the SEC requires the balance sheet for 2 years, income statements and statement of cash flows and statement of shareholders' equity for 3 years. Okay. So they've got to figure it out that that's an adequate amount of disclosures with comparative financial statements to be able to decipher through it and catch the trends. Okay, so SEC requires balance sheet for 2 years, income statement, statement of cash flows, and statement of retained earnings for 3. Selected financial data is provided as a supplemental schedule with key accounting information for the past 5 to 10 years. So some of this stuff SEC requires specific disclosures for a 5-year period, including net sales or operating revenues, income loss from continuing operations, related earnings per share, total assets, long-term obligations, redeemable stock, cash dividends declared per share, and obviously they include other information. We'll move on from that. So pretty much they just want to know a lot of stuff, right? So how do we exactly analyze balance sheet information? So first, the financial analysis, we take comparisons with the intracompany and intercompany right here. Common size analysis, rate of change analysis, and ratio analysis. So pretty much that's just a little figure there going through. I'm not going to really harp on that much. Intracompany and intercompany comparisons. Time series analysis evaluates a company's financial performance and condition over time. Okay, so that's pretty self-explanatory. Intracompany comparison is analyzing a company's current financial information in light of its performance in prior periods to reveal trends. Valid intercompany comparisons require consistency in accounting methods and principles over time. So once again, this is showing the importance of the matching and revenue recognition and all that. How you have to, if you pick a method, you have to stick with it, okay? Unless you have a good reason for change. So that's the main reason, because we want to be able to make comparisons. Because once again, what's the overall goal of financial information, financial statements?
Provide important information for making decisions.
Right. So that's why we're just, you see, it's all coming back around, and we just want to make sure everything's consistent and accurate, right? Cross-sectional analysis compares a company's financial position and performance with that of key competitors or the industry averages or related industries. So once again, that's another word for benchmarking. I'm sure everyone's heard of benchmarking, comparing yourself with other firms in an industry. Intercompany comparison is analyzing a company's current financial information against similar data from other companies. Once again, that's another thing like benchmarking, for the most part, just at a more concentrated focus. Comparable financial information may be from an individual company or an industry average. Common size analysis requires users to compute the percentage amounts of each item on the financial statement relative to the base amount. Items on the balance sheet are expressed as percentage of total assets. Makes sense. Items on the income statement are typically expressed as a percentage of total revenue, so that way you can see, like on a percentage, items on the revenues, expenses, percentages of total revenues. That way you can see how, like, each expense, how much it's absorbing of your revenue, right? So if you just see those percentages, a lot of times when you get into practice, if you go into accounting and you're printing out these reports, you can choose whether you want to have this breakdown of the analysis, and it'll show you the actual percentage of your revenue, which is obviously 100%, and then it'll break down your gross profit percentage and your expenses, so that way you can see how much of each line items is consuming of your revenue. So pretty good little tool there. And obviously, same thing in balance sheet. It's just showing you the relative, size of that asset to compare it to the overall assets. Here's common size analysis here, and what we can see here, dollar amount in millions. We just have the assets listed in the different years. You can just see we're just comparing data here, really. I'm not going to really harp on that a lot. Common size analysis, here we are on the balance sheet with assets. So we can see it, because total assets, like, so 542.3 for 2017, that's going to be 3.8%. at the 14,365. Everyone seeing that? So on and so forth. So each individual, like once again, 2016 for property, plant, and equipment net, this 4,533.8 is going to make up 31.7% of the 14,312. So not bad. Just punching in numbers and looking at it. Same thing. Not really. I mean, it's the same song and dance every slide, so we're getting it. That makes sense to everybody? No need to harp on that, right? Is anyone confused on any of that? It's basic, just basic analysis, just basic division pretty much. Okay, rate of change analysis is computing the percentage rate change in a company's financial position and performance over time. It says here, this is frequently used to compute the rate of change in specific line items reported on the balance sheet and income statement. Each line item is expressed as a percentage rate of change from the base period. It says here, method cannot be used if base period is 0 or less than 0. Once again, rate change analysis. Here we go, right through here. And once again, I'm not really too concerned about these analysis right now with everything. I'm more concerned about learning the framework and everything. Even though these analysis, they are good tools. Pretty much it's the same thing we were just looking at. Okay. All these making sense to everybody? We don't need to go into them in more detail. You're not really going to be seeing, I'm not going to be hitting you with any of the analysis stuff. If it is, it'll be something it'll be a basic one, something like debt to equity or something like that. Okay. I'm not going to have you really get into this because reason being is most likely you're going to have a financial analysis class. Okay. That's going to teach you a little more on how to analyze the financial statements. I'm more concerned with knowing how to build them and the measurement attributes and all that stuff is on the framework. Not to say it's not important because it is, but that's why I just want to touch on it just vaguely here. Okay, ratio analysis. Okay, so this is the one. This is the part that I'm more concerned with. The other ones is still important, but the ratio analysis is the one that we would use more so in this class. Okay, financial statement analysis ratios represent relationships between and among items on the financial statements. Okay. So it's used to make intra-company and intercompany comparisons by external users for many economics decisions, okay? So we can see why these are going to be important, very relevant, right? Because this ties into the overall point of the financial statements for the external users, right? So the main decisions that are based upon financial statement analysis is listed here. We can see return on investment, risk, liquidity, financial flexibility, and operating capacity. Okay, so we can see why each one of these decisions that we're trying to determine could be very relevant in making an investment decision, right? So let's start with return on investment. So this is the rate of return on investment. It's going to measure how profitability and how profitability or profitable. Gosh almighty, I'm sorry. A company uses its resource, right? So how they're going to use their resources. Return on assets or return on common equity. Return on assets is going to be this formula here. We take our net income, we add our interest expense, we add it back, and then multiply it 1 minus the tax rate, okay? That's going to be divided by average total assets. So once again, net income, we add back interest expense and multiply it by 1 minus the tax rate. Divide it by average total assets. Return on common equity is just net income divided by average total common shareholders' equity. Okay, here's some examples right here on the return on investment. It says here, Startbooks 2017 information. We have net income of what's it say? 2,884.9 million. Big number there. Interest expense of 92.5 million, and then the effective income tax rate is 33.2%. So all we do is we just take this information here and just punch it directly into the formulas here. So the return on assets, once again, it's giving you what the period is. I mean, what the formula is again right here. And then right here, we're just punching it in. We know here's the net income. Then we add in right here the income attributable to non-controlling interest expense 1 minus tax rate. So interest expense times 1 minus the tax rate will be 61.8 if we go through just the math right there. Interest expense times that. So that's why we're adding net income plus that, and then divide it by the average total assets. So average total assets. The reason why we're seeing two amounts here divided by 2, the way you find average total assets is you take assets at the beginning of the period, assets at the end of the period, and divide it by 2. Okay. Next, return on common equity, net income over average total common equity. Once again, we just take our net income as your numerator, and then the denominator, once again, is the average total common equity. So that's the beginning of the period equity as of January 1 plus the end of the period equity as of December 31st, and then we divide it by 2. That's the average. Okay, so anytime you're asked to find anything of average, whether it be like, for another example, like accounts receivable turnover and stuff like that, if they ask you for the average accounts receivable, all it is beginning period accounts receivable plus the ending period divided by 2. Obviously, that makes sense because that's the average throughout the period. Everyone good on those formulas? Not bad. They're pretty straightforward, pretty simple. If you know the formula, then you can just take the numbers and just punch them into a calculator and good to go. Risk and financial flexibility ratios. These are going to be used to assess the leverage and long-run solvency of a company. What's the solvency of a company? How financially sound a company is, right? How solvent it is, right? So ratios are complementary. Greater risk usually implies less financial flexibility, and vice versa. It says here these ratios provide evidence of the risk of the capital invested in the company by financial stakeholders, including lenders, preferred shareholders, and common shareholders. So pretty much these are just going to tell them how risky their investment is. Because obviously the solvency of a company is going to determine the longevity of it, right? Because if it's not very solvent, then the chances are it could go bankrupt, right? Financial leverage refers to the amount of debt financing relative to the equity and total assets of the company. Greater leverage typically is a key indicator of greater financial risk, okay? Standard ratios that measures the leverage include the debt to assets ratio and the debt to equity ratio. The debt to asset ratio measures the percentage of total assets financed by creditors. So debt to assets is just total liabilities divided by total assets. Not bad, right? So these are the type of things that if I'm asking you anything ratio wise, it would be something like this, okay? So I'm not, like I said, I'm not going to go into detail on those big spreadsheets. Debt to equity ratio, that measures the number of dollars of debt financing per dollar of financing from total common shareholders' equity. So debt to equity, once again, is just total liabilities divided by total common shareholders' equity. Makes sense, right? Debt to equity. Debt to assets, once again, just liabilities to assets. Pretty simple, right? All right, I think that'll be a good stopping point for today. We've only got a few slides left, and we'll wrap those up first thing on Monday before we get into chapter 5. And pretty soon we're going to start. I was telling Will here. Pretty soon I got hooked up to the Elmo, so I think we're about through most of the stuff that was just boring of getting through the slides. So pretty soon we're going to start actually working some problems out and stuff too that we're actually seeing in the slides, so we can get a better understanding of that. I'll be posting the homework and the quiz probably today. I'll make sure that now that we're about through the chapter, I'll make sure everyone has plenty of time to work on that. So be on the lookout for the quiz for chapter 4 and the homework for chapter 4, and we'll just reconvene on Monday. Sound good? Well, I appreciate your all's time. Is everyone everything making sense to everybody? I know we're kind of moving through the chapter. I'm trying to catch up where we missed Monday, but is everyone cool on all the topics covered so far? Okay, cool deal. Please let me know if I'm moving too fast or if anything's tripping you up or anything. Okay. All right, cool deal. Appreciate y'all's time.